Most traders have the same painful experience. The moment they enter a trade, price immediately moves against them. You wait for confirmation, you see the crossover, you click buy or sell, and within seconds you're in drawdown. It feels like the market is watching you, waiting for your entry just to punish it. But this isn't bad luck, and it's not manipulation against you. It's because you're entering where liquidity sits, not where institutions enter. You're reacting to signals instead of understanding timing, pressure, and context. Until you fix where and when you enter, every strategy you touch will feel cursed. So what you're going to witness today is one of the most profitable and heavily back-tested EMA crossover models available, with an accuracy rate reaching up to 86% when traded with proper context and rules. Not because EMAs magically predict price, but because this strategy aligns timing, momentum, and institutional pressure into one framework. It filters out chop, avoids emotional entries, and activates only when the market has already committed to a direction. That's why it works across markets, across time frames, and across years of data. While most EMA strategies lose money because they're traded blindly, this one flips the script, turning a simple crossover into a precision-based execution model used by disciplined traders, not gamblers. Now for the strategy. First, you need to add 3 EMAs to your chart, and each one has a specific job. Open your indicators, search for exponential moving average, and add it 3 times. Set the first EMA to 20, the second to 50, and the third to 200. These are not random numbers. The 20 EMA represents short-term momentum. It shows you when price is being pushed aggressively and when momentum is accelerating or dying. The 50 EMA acts as trend pressure. It's where pullbacks respect strength and healthy trends, and where weak moves get rejected. The 200 EMA is the line institutions care about most. It defines market bias, separates bullish from bearish environments, and tells you which direction you're allowed to trade. When price is above the 200 EMA, you stop thinking about shorts. When it's below, you stop forcing longs. Together, these 3 EMAs don't predict reversals. They organize chaos, align momentum with structure, and filter out low-probability trades, so you're only active when the market has already chosen a side. This EMA crossover strategy works because it doesn't try to outsmart the market. It waits for the market to prove direction first. Once the 3 EMAs are on your chart, your entire job is to trade alignment, not anticipation. When price is clearly above the 200 EMA, the market isn't a bullish environment, meaning institutions are already positioned to the upside and selling pressure is weak. Now you wait for the 20 EMA to cross above the 50 EMA, which signals that short-term momentum is accelerating in the same direction as the broader trend. This crossover is not the entry, it's the permission slip. The real power comes from patience. You wait for price to either pull back into the 20 to 50 EMA zone or compress slightly after the crossover, showing that aggressive buyers are defending their positions rather than exiting. This is where most traders get emotional and chase candles. You don't. You enter only when price respects the EMAs and then expands again, confirming continuation. Your stop loss is placed beyond the most recent swing low, where the idea is clearly invalidated, and your targets are set at obvious liquidity highs, letting the market pay you for staying aligned with momentum. And when price is clearly below the 200 EMA, the market is in a bearish environment, meaning institutions are already positioned to the downside and buying pressure is weak. You then wait for the 20 EMA to cross below the 50 EMA, signaling that short-term momentum is accelerating in the same direction as the broader downtrend. This crossover is not your entry. It's your permission to look for shorts. The real edge comes from patience. You wait for price to either pull back into the 20 to 50 EMA zone or compress slightly after the crossover, showing that sellers are defending their positions rather than covering. This is where most traders panic sell breakouts. You don't. You enter only when price rejects the EMAs and expands lower again, confirming continuation. Your stop loss is placed beyond the most recent swing high, where the bearish idea is invalidated, and your targets are set at obvious sell-side liquidity lows, allowing the market to reward you for staying aligned with downside momentum. Timeframe selection is critical for making this EMA crossover strategy work consistently, because the EMAs behave differently depending on the chart you trade. For higher accuracy and cleaner moves, this strategy performs best on the 15-minute, 30-minute, and 1-hour timeframes, where institutional order flow is clearer and false crossovers are reduced. On these timeframes, the 200 EMA defines true market bias, while the 20 and 50 EMAs reflect genuine momentum shifts rather than noise, allowing trends to develop and continue smoothly. This is ideal for intraday and swing traders who want structure, patience, and fewer but higher quality trades. For scalpers, the strategy can be applied on the 1-minute and 3-minute time frame, but with caution. Lower time frames amplify noise, meaning EMA crossovers occur more frequently and can fail without warning. Because of this, scalpers must use additional confluences such as session timing, London or New York, nearby liquidity levels, market structure, or strong displacement candles to confirm entries. Without these extra filters, EMA crossover becomes guesswork. The rule is simple. The lower the time frame, the more confirmation you need. This strategy rewards patience on higher time frames and precision on lower ones, but only when time, trend, and momentum are aligned.